every single investment decision you ever face. I mean, whether you're just picking a single stock for your own portfolio or, evaluating a huge corporate acquisition, it all requires you to make one fundamental calculation. It's that trade-off between risk and return.
Exactly.
We all instinctively know it, right? If you want a shot at a higher return, you have to accept higher risk. But the question that really launched modern financial economics was, how do we objectively price that risk?
Right. How do you put a number on it?
Exactly. How do you precisely quantify how much extra return is required for taking on, say, one more unit of market volatility?
And that core problem, that search for the objective price of risk, well, that's the entire mission of the capital asset pricing model, or CAPM, as everyone calls it.
And that is our deep dive today. We are getting into a formula that is, and this isn't an exaggeration, truly foundational. I mean, CAPM is the cornerstone model that corporations use to figure out their cost of equity.
And that portfolio managers use to justify their investment choices, or in many cases, fail to justify them.
Right. It's this incredible intellectual structure, and it's all built on the idea of a perfectly rational investor.
Fundamentally, what CAPM is, it's a tool. It's designed to determine the theoretically appropriate required rate of return for any given asset.
Okay, the rate you should be demanding.
Precisely.
Yeah.
And crucially, and this is a point we'll come back to again and again, it assumes that asset is being added to an already well-diversified portfolio.
That's a huge assumption.
A huge one. And what makes it so powerful and so popular, really, is its simplicity. It gives you a mathematically derived cost of equity capital, and it's determined by just one single factor.
And that factor is the asset's exposure to non-diversifiable risk.
The thing that the entire financial industry just calls beta.
And here is the paradox. I mean, we have to acknowledge this right at the start because it's what makes this dive so fascinating for any learner. CAPM it's ubiquitous. It's simple, it's elegant, it's taught in every single business school on the planet. Yet, as our sources show, decades and decades of empirical tests have proven that the model, well, in its purest form, it often fails to predict real-world returns.
It really does.
It is the formula that failed, but somehow still rules the world of finance.
And that's its enduring legacy. To understand why it still rules, you really have to appreciate the purity of its theory. The model itself was built upon the shoulders of Harry Markowitz's earlier work.
On modern portfolio theory.
Exactly. The key architects who really developed CAPM as we know it today were Jack Traynor, William F. Sharpe, John Lintner, and Jan Mawson. And they were all working independently in the early 1960s.
It was just this rapid intellectual explosion, wasn't it? All centered around like 1961 to 1966. And of course, that work secured its permanent place in history when Sharpe, along with Markowitz and Merton Miller, received the 1990 Nobel Memorial Prize in Economic Sciences.
Of a landmark achievement, no question.
A landmark, even if its actual performance in the real world is, well, it's questionable.
Okay, so let's unpack this concept of risk, because CAPM doesn't view all risk equally. Before we even touch the formula, we have to establish which risks we actually care about and which ones we should just, get rid of.
That distinction is the true genius of modern portfolio theory, which, as you said, CAPM inherited. We're dealing with the two faces of risk that any investor is going to encounter.
Let's start with the face we can actually control, unsystematic risk.
Right. This is often called idiosyncratic risk, or maybe more helpfully, diversifiable risk. The key characteristic here is that it's unique to a specific company or a specific asset.
So, like a scandal.
A perfect example. If a pharmaceutical company fails a phase 3 drug trial, or a CEO gets caught in an accounting scandal, that event really only affects that security. It's just asset-specific noise.
And then there's the other face, the risk we can't escape, which is systematic risk. That's the big one. Non-diversifiable risk, or just market risk. This is the macroeconomic risk that's common to all securities, just to varying degrees.
Okay, so what are we talking about here?
Think of the big drivers. Inflation spiking, the Federal Reserve hiking interest rates, a sudden global recession, a major geopolitical shock. If the overall economy contracts, almost every single stock drops. You just can't diversify away from that kind of decline within that market.
And this leads us directly to the great mandate of CAPM, right? The power of diversification. The model assumes the investor is rational.
Right.
And a rational investor should never, ever take on diversifiable risk. Why? Because the model states very clearly that only non-diversifiable risk is rewarded with a premium return. You don't get paid for holding on to company-specific bad luck.
That's the critical insight. It's so important. When you assemble a portfolio, The specific risks of those individual assets, they're designed to average out or cancel each other out.
So the good news from one company offsets the bad news from another.
Exactly. Therefore, the required return on any single asset is only linked to its contribution to the overall portfolio riskiness, not its own unique standalone risk. That standalone risk becomes irrelevant once you diversify.
So practically speaking, what does it take to get diversified enough to satisfy this model? I mean, do you, the investor, need to own 5,000 different stocks from all over the world?
Well, our sources suggest that, in large developed markets like the US or the UK, the bulk of the benefits are actually achieved pretty quickly. A portfolio of about, say, 30 to 40 randomly selected non-correlated securities is usually sufficient.
30 to 40 stocks, that's it.
That's usually enough to essentially eliminate the vast majority of that unsystematic risk. At that point, your risk exposure is primarily the systematic market-wide kind.
Okay, but there's a catch, I assume.
There's a big caveat, yes. In less developed emerging markets, asset volatilities are much higher and the correlations between them can be, well, they can be strange. You'd likely need a significantly larger number of assets to achieve that same level of protection.
Okay, so once we've assumed the investor has successfully diversified away all that idiosyncratic risk, we're left with only systematic risk. And that's where we need a measure.
You need a ruler.
A ruler. And that measure is beta. I always see beta as like a financial Geiger counter. It measures an asset's unique exposure to that remaining inescapable market risk.
That's a perfect way to put it. Beta is the one and only variable CAPM uses to justify why different assets should have different required returns. It measures an asset's sensitivity to that non-diversifiable market movement.
Okay.
Technically speaking, it quantifies the sensitivity of the expected excess asset returns to the expected excess market returns.
Let's lay out the benchmarks then, because beta numbers are basically a universal shorthand in finance. What's the baseline?
The baseline, by definition, is a beta of 1. The market as a whole, which we usually proxy with a broad index like the S&P 500, has a beta of exactly 1.
So an asset with a beta of 1 just moves perfectly in sync with the market.
That's the idea.
So if the S&P 500 goes up 10% in a year, a stock with a beta of 1 is also expected to go up 10%, all else being equal. What about the higher risk assets?
Well, if an asset has a beta greater than 1, let's say 1.5, it means the asset is fundamentally leveraged to market movements.
Like, what kind of stocks are we talking about?
Think aggressive growth stocks, cyclical tech companies, luxury consumer goods, things people buy when the economy is booming. If the market rises 10%, that stock with a 1.5 beta might rise 15%. It carries more systematic risk exposure, and therefore it's expected to generate a higher return to compensate the investor.
And then conversely, you have the defensive lower risk plays.
Exactly. Assets with a beta less than 1 indicate they are less sensitive than the market average. So beta of 0.7, for instance.
And these would be?
These are your classic defensive stocks utilities, established consumer staples like toothpaste companies or big telecom providers. If the market drops 10%, these stocks might only drop 7%. They're associated with lower systematic risk and therefore imply a lower required return.
Okay, to really appreciate beta, I think we have to look at the math behind it. You defined it using covariance and variance, and for the learner, that can sound a little dense. So let's look at the formula and then maybe translate it into simple movement.
Sure. The formula is the covariance of the asset's return and the market's return, divided by the variance of the market's return. And what's fascinating here is what that ratio is actually doing.
Right.
The numerator covariance that just measures how much the asset's returns and the market's returns move together. Are they highly correlated? Do they surge and fall in unison?
Okay.
And the denominator, the variance of the market return, is simply a measure of the market's total volatility. It's just its own internal movement.
So we're taking the degree to which our specific asset is sensitive to the market's ups and downs, and we're dividing it by the market's own total movement.
Precisely. And by doing that division, beta gives you a clear, standardized ratio. If a stock's movements, its covariance, are twice as large as the market's own movements, its variance, then that stock has a beta of 2.
It's just a simple ratio.
It strips away all the noise and tells us exactly how sensitive that stock is to the big macroeconomic tides. It gives us a really robust measure of its systematic risk contribution. So with beta established as the one and only driver of price risk, we can now assemble the standard CAPM framework. This is the central equation, the one that connects that systematic risk directly to the expected return an investor has to demand. The standard CAPM formula for the expected return on an asset whole is the risk-free rate plus beta times the market return minus the risk-free rate.
Okay, let's walk through this piece by piece because every component is important. Everything is what we're solving for, right? The expected or required return on our asset. This is the minimum return an investor demands to even consider holding that asset.
And we begin with true dollars, the risk-free rate. This represents the absolute floor of returns. It's the reward you get just for committing capital over time with absolutely zero systematic risk.
And in the real world, what do we use for that?
Typically, this is proxied by the return on short-term government debt, like a U.S. Treasury bill.
Okay, so that's our baseline. Then we define the engine of the market, ERMMSLS, the expected return of the market portfolio. What do we generally expect the whole market to deliver?
And that term in the parentheses, the market return minus the risk-free rate. That is absolutely crucial. This is the market premium.
Or sometimes called the market risk premium.
Right. It's the generalized reward the market offers just for accepting average market risk over and above that risk-free floor. If you had a beta of 1, this entire amount would be your reward for taking on risk.
But because we have individual assets with different sensitivities, we scale that market premium using the asset's unique beta. So if your beta is 0.5, you only get to claim half of that market premium.
And if your beta is 2, you claim double the market premium. It's perfectly proportional. The logic is that the asset's reward is perfectly calibrated by its unique sensitivity. And we can express this even more clearly if we rearrange the equation a bit.
Okay, so if we just subtract the risk-free rate from both sides,
we get what's called the risk premium form. It states that the individual risk premium an asset delivers, that's its return above the risk-free rate, must be exactly equal to the market premium scaled by beta.
Which just confirms that central idea.
It confirms the central theoretical thesis. The reward for risk has to be perfectly linear and proportional to systematic risk across every single asset in the market.
Okay, so if the formula is the brain, then the security market line, or SML, is the visual body of CAPM. It's the graph that analysts use to translate all this theoretical math into practical investment decisions. It's where you can spot potential market errors.
The SML is just a graph of the CAPM formula. It's that simple. On the x-axis, we plot risk, and remember, only systematic risk, measured by beta. And on the y-axis, we plot the expected return.
And if you look at that line, you can immediately see the structure of the formula. The intercept, where beta is 0, that has to be the nominal risk-free rate, $4. That's the reward floor for taking no market risk.
And the slope of that line, how steep it is, that represents the market risk premium. A steeper slope just means the market is demanding a higher compensation for taking on risk. And this line, in theory, defines perfect market equilibrium.
And this visualization is where the rubber meets the road for anyone interested in active management, isn't it? Because in a theoretical CPM world, every single security should plot directly on the SML.
They should all line up perfectly.
But in reality, they don't.
So if we plot an asset's expected return and its beta, and we find it sits above the SML, CAPM tells us that that asset is undervalued.
Why undervalued?
Because it means that for the level of systematic risk it carries, its beta, it is currently offering a return that is greater than what the market theoretically requires. The market is basically giving you a bonus return for that level of risk.
So if an asset is offering a 12% return for a risk level where the SML says it should only offer 10%, an active investor would see that 2% difference as a clear buying signal.
Exactly. The expectation is that demand for that asset will push its price up,
which in turn drives the expected future return back down until it lands on the SML.
Right. And conversely, if an asset plots below the SML, it's overvalued. You are accepting a return that is less than what the market demands for that specific amount of systematic risk. The expectation is that the asset's price will fall, which naturally drives its future expected returns back up toward that equilibrium line.
That deviation, that vertical distance between where the asset's actual return is and where the theoretical SML says it should be, is so important that it earned its own famous measure. Jensen's alpha.
Jensen's alpha, or just alpha, is the formal measurement of that abnormal return relative to the SML. It's essentially a mathematical way of measuring the error term in the model. Or, for a portfolio manager, it's a measure of their skill.
And we can incorporate alpha right into the CAPM equation as a sort of residual term, can't we?
We can. A positive alpha means the asset has outperformed the return expected based purely on its systematic risk and the market premium. It suggests the asset is undervalued, or maybe the manager found a true market inefficiency. This is the return that cannot be explained by beta alone.
And generating positive alpha is what active fund managers are paid, massive sums of money to do. If a fund manager generates a 15% return in a market that gave 10%, and their fund's beta was exactly 1, they have 5% alpha. They generated excess return that the standard model couldn't predict.
And a negative alpha is, of course, the dreaded opposite, underperformance. It often suggests overvaluation, or simply that the manager destroyed value relative to the risk they took on. And if an asset has a 0 alpha, it's considered fairly valued and plots directly on the SML.
So we've established that CAPM outputs this required return, EWAR. Let's turn to the practical application now. Why is this number so essential in corporate finance and investment banking?
Because it is the required discount rate. The year usagry that CAPM generates provides the asset-appropriate required return, and this number becomes the critical component for determining a company's cost of equity.
Which then feeds into the WACC, the weighted average cost of capital.
Exactly. And without that rate, companies can't accurately assess whether a new project, building a new factory, launching a new product, is actually going to create shareholder value.
It's a really intuitive relationship, isn't it, between risk and discounting? If I need a higher return to take on higher risk, then that higher return must translate into a higher discount rate that I apply to any future cash flows.
It has to. A stock with a high beta will have a high required return, and therefore its future cash flows will be discounted at a higher rate. Less sensitive stocks, with lower betas, are discounted at a lower rate. This reflects a fundamental aspect of investor behavior, which is described by what economists call the concave utility function.
Okay, that's a bit of academic jargon. Can you break down what the concave utility function means for someone just learning this?
Sure, it just means that investors are risk-averse. They value the first dollar they gain much more than the 100th dollar they gain. Therefore, to persuade a risk-averse investor to take on a higher level of risk, you have to offer them a disproportionately larger amount of expected return.
The more risk I take, the more you have to pay me, and at an increasing rate.
At an accelerating rate, exactly. So the higher discount rate we use for high beta stocks just reflects this behavioral requirement for compensation. So once that required return, it's established via CAPM, it is plugged directly into the foundation of all fundamental valuation, calculating an asset's intrinsic value based on its expected future cash flows.
This is the classic present value calculation. We take all those future cash flows we anticipate the company will generate, and we shrink them back to today's dollar value using that CAPM-derived rate. The formula for the intrinsic present value, or PV, is just the sum of all those discounted future cash flows.
And the resulting PV is the theoretical fair price for that asset today. This gives you the most important valuation comparison you can make. If the PV you calculate is higher than the current market price,
then the asset is undervalued.
It's undervalued. You are essentially buying its future cash flows at a discount relative to their systematic risk.
And if the current market price is higher than the intrinsic value calculated, then the asset should be considered overvalued. This is the mechanism, the nuts and bolts, by which CAPM translates risk into a tangible, actionable price tag.
And I should probably mention, our sources note that CAPM can also calculate the asset price using an alternative structure. It's sometimes called the certainty equivalent pricing formula.
Okay, that sounds a little esoteric. How is that different from the standard present value calculation we just discussed?
It's just another way to frame the exact same idea. Instead of adjusting the discount rate, the denominator for risk, the certainty equivalent method adjusts the expected cash flows, the numerator.
How does it do that?
It calculates the certainty equivalent cash flows. That's the guaranteed amount of money today that an investor would accept instead of the risky future cash flows. Then you just discount that guaranteed amount at the risk-free rate.
So you either adjust the cash flow for risk or you adjust the discount rate for risk.
Exactly. Both methods lead to the same result, but the certainty equivalent approach focuses on risk adjusting the cash flow itself instead of the rate.
So we have the year I, the rate that CAPM demands we earn, and it's derived purely from beta. How do we turn that into an actual investment decision?
Well, you have to compare that CAPM required rate of return to an independent estimate of the asset's actual return outlook.
Right.
CAPM can't tell you what the future cash flows will be. You have to do that work yourself.
So you need separate analysis.
You need fundamental analysis, maybe technical indicators looking at PE ratios, comparing it to similar firms using market-to-book ratios, and so on.
Okay, let's put some numbers on it to make it concrete. Let's say CAPM tells me that based on this asset's beta, its required return is 9%. But based on my own deep dive into the company's expected growth and its dividend policy, I calculate that the current market price will actually generate an expected return of 11%.
That 2% discrepancy is the key signal. If the expected return of the asset, your 11%, is higher than what CAPM says is required, the 9%, it implies that the current market price must be too low.
The asset is undervalued.
It's undervalued. Assuming, of course, that the market is efficient enough to eventually correct that price, which would pull the expected return back down to the required 9%. The pricing implication is simple. Find assets where the expected return exceeds the required return and buy them. So we've spent a lot of time admiring the simplicity and the utility of CAPM, but now we have to confront its intellectual foundation, because the model only works perfectly if the real world adheres to a set of extremely strict and often very unrealistic theoretical assumptions.
Oh, reading this list of assumptions really makes it clear that CAPM is describing a financial utopia. It's a frictionless world where every single actor is a math genius. Let's start with the behavioral side of things.
Well, the model requires investors to be perfectly rational and risk-averse. They're always trying to strictly maximize their economic utility. And quickly, they must share what are called homogeneous expectations.
What does that mean in plain English?
It means every single investor has to agree on the probability distribution of potential returns and risks for every single asset. So if your expectation of Google's future growth differs from mine, the model starts to break down.
That seems like an impossibility right there. Everyone processes information differently, but it gets even more restrictive, doesn't it? They must also have all information available at the same time, and no single investor can influence prices. They're all price takers.
Then you hit the assumptions about the market structure itself. The market has to be absolutely frictionless. That means zero transaction costs, zero taxes. And assets must be perfectly divisible and perfectly liquid, so you can trade fractions of a penny instantly and without any cost.
Wait, let me stop you on the most famous, or perhaps the most infamous, assumption of them all. The ability for investors to lend and borrow unlimited amounts of money at the exact same risk-free rate. That just seems like a complete fantasy for the average person.
It's a profound abstraction from reality. That one assumption, coupled with all the others, is what allows every investor to achieve an optimal, diversified portfolio on what's called the efficient frontier. It leads them all to hold the exact same market portfolio.
It's necessary for the math to work.
It's essential for the mathematics of the equilibrium to hold. But it is deeply, deeply disconnected from financial reality, where lending rates are always higher than borrowing rates, and nobody can borrow unlimited money.
So these 9 core assumptions, they create this elegant theoretical construct, but it's one that demands a financial world that just doesn't exist. It's really no wonder the model started facing issues as soon as it hit real-world data.
Right. And because that assumption about the risk-free asset, the ability to lend and borrow freely at that one rate, was such a high hurdle, Fisher-Black developed a really influential variation back in 1972 to get around it. This is the Black CPM, or the zero-beta CAPM.
Okay, so if the model can't rely on the existence of a perfect risk-free asset that everyone can borrow against, how did Black adjust the formula?
You replace the restrictive risk-free rate, 10 authors, with the return of a theoretical zero-beta portfolio. We'll call it ERIZ.
What exactly is a zero-beta portfolio?
It's a portfolio that's constructed from risky assets that, when you combine them, have a weighted average beta of 0. Therefore, it's a portfolio that has no correlation with the movements of the overall market.
So it's not risk-free in the sense that it has no volatility?
No, not at all, because it is made of risky assets. But its systematic risk contribution is nil.
So instead of benchmarking everything against a government bond, you're benchmarking against a basket of stocks and bonds whose systematic movements just happen to cancel each other out. The Black KPM formula looks just a little bit different then.
By substituting that zero-beta return for the risk-free race, Black created a model that actually proved to be far more robust when you tested it empirically. It was particularly successful in addressing a major initial finding.
Which was what?
That the observed security market line in real markets was often flatter than the standard CAPM predicted it should be.
Wait, why would the Black KPM lead to a flatter SML? That seems counterintuitive.
Well, in the real world, the minimum rate you can earn without systematic risk, that's the zero-beta portfolio return, is often higher than the theoretical risk-free rate, because you're still taking on some unsystematic risk in that portfolio.
Okay, so the starting point of the line is higher.
Right. And at the same time, high beta stocks often underperform what CAPM predicts. So by raising the baseline return and simultaneously acknowledging that the rewards for high beta are often lower in practice, the black KPM effectively pivots the SML, making it flatter and a much better fit for real-world observations.
We've established the beauty, the elegance, and the very strict theoretical requirements of CAPM. Now we have to dive into the section that, for me, provides the most crucial insight for the learner. The undeniable evidence that, despite its intellectual pedigree, the model simply does not work that well in the wild.
And this failure, it's not a matter of mild academic debate. It's really the consensus view among leading financial economists. It's perhaps best summarized by Eugene Fama and Kenneth French, whose work fundamentally challenged CAPM.
And what did they say?
They stated in their 2004 review, and this is the quote, "The failure of the CAPM in empirical tests implies that most applications of the model are invalid."
Wow. That is a staggering indictment for a Nobel Prize-winning framework that's taught globally. It tells you right away that modern finance is built on a foundation that we all know is cracked. Let's look at some of those specific the empirical failures.
The most direct failure lies in that relationship between risk and return itself. CAPM predicts the relationship is linear and steep. You must take on proportionally more beta risk to get a proportionally higher return. But the data shows the SML is often significantly flatter than predicted.
And this flatness points directly to the biggest statistical anomaly that challenged CAPM's dominance, doesn't it? The low volatility anomaly. What does this pattern look like in practice?
It means that if you analyze decades of market data, you find that low beta stocks, the supposed low-risk defensive assets like utilities or consumer staples, often deliver higher average returns than the CAPM model says they should. They even outperform some high beta stocks.
Which is a complete contradiction.
It's a direct contradiction of the model's central promise, that only high systematic risk gets a significant reward.
But why would that happen? Why would investors accept lower returns for higher risk? If the model is wrong and low beta stocks outperform, why are people still piling into aggressive high beta tech stocks?
That's the behavioral gap. Researchers have found that investors are often constrained. They may not be able to borrow money at the risk-free rate to leverage up their safe low beta portfolio. So instead, they gravitate toward high beta stocks, hoping to achieve high returns through volatility, even if those stocks are statistically overpriced relative to their true risk.
It's also just optimism, right?
It's optimism and the hope of massive outsized gains, the lottery ticket effect.
So beta was supposed to be the single unifying factor that explained everything, but it was proven to be insufficient because it just couldn't explain historical outperformance in specific segments of the market.
Right, and those are the famous size and value effects, discovered primarily by Fama and French. They observed systematic historical outperformance from two specific types of stocks that beta just couldn't account for.
And those were?
Small cap stocks companies with smaller market capitalization, that's the size effect, and value stocks, which are companies trading at low multiples of their book value, the value effect. These stocks consistently generated returns that were higher than CAPM predicted for their level of beta.
And finally, there's the issue of time. The model treats beta as this reliable, static constant.
Yes, the convenience of the model requires treating beta as a single, fixed number. But in the real world, beta is highly time-varying.
It changes.
It changes constantly. A company in a cyclical industry, say heavy manufacturing, might have a very high beta during a recession when investor confidence is low, but a much lower beta during a boom when its earnings are stable. Relying on a historically calculated fixed beta for a valuation model just breaks down when that company's relationship to the market is changing dynamically with the economic cycle.
Beyond just the statistical errors, some critics argue the entire CAPM structure is theoretically flawed from the ground up. And the most famous argument here is Roll's critique from 1977. This is where it gets really fascinating.
Roll argued that the entire model is practically untestable. And the reason is that the anchor of the whole equation, the true market portfolio, is completely unobservable.
Why is it unobservable? We use indices like the S&P 500 all the time as a proxy for the market.
But that's just it. They're a proxy. The true theoretical market portfolio must include all assets held by all investors globally. Publicly traded stocks, sure, but also private equity, government bonds, real estate, precious metals, commodities, and most importantly, human capital.
Human capital.
The present value of all future labor income for every person on Earth. We simply cannot construct a verifiable measure of this total wealth market portfolio.
So when analysts use a proxy like the S&P 500, they aren't really testing CAPM. They're just testing whether the S&P 500 is efficient relative to itself, not relative to the true total market.
Precisely. Roll's argument was that using any proxy leads to flawed mathematical inferences. If the true market portfolio is unobservable, then any test of CPM's validity is just circular and inconclusive. The model is perfect in theory, but its key variable can't be measured in reality, which makes definitive empirical confirmation impossible.
There's also a more philosophical issue with how CPM even defines risk, isn't there?
Yes, CPM assumes that variant volatility is the sole measure of risk. It treats upside volatility and downside volatility as equally bad.
Which doesn't make intuitive sense.
Not at all. It completely ignores asymmetric downside risk. Most investors don't mind volatility when a stock is going up. What they really fear is the probability of returns falling below a critical threshold, losing their capital.
And this links to the safety-first approach to investing, right?
It does. Many practical investors prioritize minimizing the probability of a major loss, rather than just minimizing overall variance. CAPM completely fails to capture this psychological preference for avoiding large losses, focusing instead on a symmetrical statistical measure that doesn't really reflect human fear.
And finally, we have to look at the factors introduced by behavioral finance and just the messy reality of markets that completely defy CPM's neat assumptions. Let's start with the ideal world versus the reality of market frictions.
The assumption of a frictionless world, no taxes, no transaction costs, perfectly divisible assets, is just a non-starter. Real-world trading costs, bid-ask spreads, capital gains taxes, regulatory restrictions, they all prevent investors from creating and maintaining the perfectly optimized, efficient portfolios that CAPM requires.
And those frictions really matter.
They matter greatly, especially in small transactions. They can completely erode the possibility of the perfect arbitrage that keeps the model in equilibrium.
And then we introduce actual human beings who are anything but rational. Behavioral finance is arguably the biggest intellectual challenger to CAPM because it shows that our psychological biases drive significant market inefficiencies.
Absolutely. Biases like investor overconfidence, herding behavior, or just simple emotional trading. They all cause price deviations that the linear, purely rational CPM cannot possibly explain. If investors are driven by emotion rather than utility maximization, the entire efficient market equilibrium that CAPM predicts just falls apart.
A great example of this irrationality in how people structure their portfolios is mental accounting.
CAPM requires the investor to view all of their assets as one single optimized portfolio. But in reality, people silo their money, don't they? They have a safe retirement account, a speculation fund, and a rainy day savings account.
Right. They treat them all differently.
They manage the risk profile of each silo separately, which completely contradicts the fundamental assumption that they're managing one unified, risk-optimized entity to maximize their total wealth. They apply different risk tolerances to different pools of money.
And this leads to something called skewness preference, which I think perfectly explains why people buy lottery tickets even though they have a terrible expected return.
That's the lottery effect. Investors may willingly accept a lower expected return for assets that exhibit high positive skewness. That just means there is a small but high-impact chance of an enormous rare payout.
And the dream of that huge win is enough.
The potential for that huge win compensates them for the statistically lower average return. CAPM, which only looks at variance, completely ignores this powerful preference, which means it systematically undervalues stocks that have lottery-like characteristics. So the incredible utility of CPM's framework, combined with its glaring empirical failures, meant that finance couldn't just abandon it. It had to try and fix it. The failures we just talked about in Part 5 were the direct engine that drove the creation of more complex, multi-factor models.
They just had to acknowledge that a single measure beta was not sufficient to describe the complexity of market returns.
Right. And the most famous and influential extension, which is often considered the modern academic successor to CAPM, is the Fama-French three-factor model.
And this model was a direct response to those empirical failures we discussed, wasn't it? Specifically, the size and value anomalies.
Exactly. Instead of relying solely on market risk or beta, Fama and French proposed adding two new independent risk factors to the equation.
What are those factors?
The first factor is SMB, which stands for small minus big. It accounts for the historical premium that we've observed in small cap stocks. That's the size effect. The second factor is HML, or high minus low, which captures the premium associated with value stocks, the value effect.
So the Fama-French model is essentially saying your required return is determined not just by your sensitivity to the overall market, but also by your exposure to the systematic risk associated with being a small company and being a value company.
That's it. And by including these three independent sources of risk, the model significantly improved the ability to explain the cross-section of expected stock returns. It just fit the data better. And we also saw extensions designed to capture that behavioral flaw we mentioned, the skewness preference. The co-skewness CAPM directly addresses that lottery effect.
It acknowledges that human desire for the rare, massive payout.
Exactly. This extension includes a term for co-skewness as a priced factor. It adds higher-order statistical moments to the equation, which is a fancy way of saying it incorporates the idea that investors are willing to accept a statistically inferior return if the distribution of those returns is positively skewed, offering that lottery-like chance.
So it's trying to model the irrationality that the standard CAPM just dismissed.
That's a great way to put it. And that other major theoretical extensions address the limitations CAPM imposed regarding investor time horizons and even the very definition of utility.
Robert Merton's intertemporal CAPM, or ICAPM, is key here, isn't it? It generalizes the model beyond just a single period.
The original TAPM was inherently a static, single-period model. It was optimized for a short time frame. ICAPM acknowledges that investors don't just optimize their portfolio today. They save over decades and need to manage risk over multiple periods, allowing for repeated portfolio rebalancing.
It seems so obvious.
The intertemporal aspect just means that investors care about the uncertainty of future investment opportunities as well as their current wealth.
So ICPM simply acknowledges that we don't buy a house and then sell it tomorrow. We save for 40 years. And that long time horizon fundamentally changes our view of risk.
That's the practical implication. And the consumption CAPM, or CCAPM, takes the redefinition of utility even further. Instead of optimizing your final wealth, CCPM argues that investors really seek to maximize their consumption utility.
So they don't care about their portfolio value fluctuating as much as they care about their ability to afford goods and services in the future, their lifestyle.
Precisely. CCPM suggests that an asset's required return should be based on how its returns cover with aggregate consumption, not just market wealth. Assets that perform poorly when overall consumption is low, like during recessions when people are struggling, are considered much riskier because they fail you when you need them most.
And therefore, they have to offer a higher return.
They must offer a higher required return to compensate for that risk.
And finally, we noted the issue of horizon misalignment when it comes to the risk-free rate.
This is a really practical point. For long-term investors, the choice of the appropriate risk-free rate, CAPM, really changes. If you are saving for retirement decades from now, a short-term treasury bill rate isn't the most relevant benchmark.
So what should you use?
Well, long-term investors might optimally choose assets like inflation-linked bonds as their true risk-free asset, because their primary goal is to maintain purchasing power over a very long time horizon. This means the intercept of the SML isn't fixed. It depends entirely on the investor's individual timeline and objectives.
It seems like the more we learn, the more we realize that every single simple component of that original elegant CAPM formula had to be complicated, adjusted, or completely replaced just to try and align the theory with the real world. So what does this all mean for you, the learner? We've completed our deep dive into the capital asset pricing model, moving from its magnificent theoretical structure all the way to its systematic empirical breakdown. Its core purpose to define required return based solely on systematic risk, or beta-changed finance forever.
And despite all those powerful critiques, the low volatility anomaly, the size and value effects discovered by Fama and French, and Roll's powerful argument that the true market portfolio is unobservable, CAPM remains the essential foundation. It provides the intellectual framework, the vocabulary, and the starting point for nearly all modern valuation.
Its failure was constructive, in a way.
It was incredibly constructive. It led directly to the creation of the multi-factor models that we use today.
It is the lingua franca of valuation, used daily across corporate finance to justify discount rates and asset allocations. It's the simple, beautiful, but ultimately incomplete map that forced us to acknowledge the vastly more complicated terrain of real financial markets.
And that leads to a final provocative thought for you to consider. The elegance of the original CAPM required us to assume that every single investor is a perfectly rational, utility-maximizing machine, given that the greatest contribution of CAPM wasn't its accuracy and prediction, but rather the fact that its failure forced us to define, measure, and then ultimately break the rules of rationality by discovering behavioral anomalies. What does that imply about the human element that we will always fail to fully model in our search for the perfect investment?
That's a profound thought. The human brain, not the beta, might just be the final unpriced factor. Thank you for joining us on the deep dive.